Hey Bowtie Nation, Joseph Hogue here with an update to the official Bowtie Index, ticker BOWT, and 6 stocks in the index that could surprise big time in 2023 with a bounce in profits. We're talking about stocks in the financial sector, and all you out there in the nation know I've been watching the bank stocks in this sector for all year. We're seeing a replay of what we saw during the pandemic, where banks stashed away tens of billions of dollars in that what-if cash, and when that worst-case scenario didn't happen, ended up posting gains of 126% on the KBE Bank ETF over the following year. Now in this video, I'll explain exactly what that means, along with those 6 stocks I'm buying for the Bowtie Index. I'll also show you how the index works and why it has the potential to beat the market. If you want to see all the stocks in the index though, go to Stock Card and click on the Idea Center. Click on Indexes and you'll find the Bowtie Index. From there, you'll see the methodology I'm using to pick stocks, the videos detailing it, and some great ways to contribute your own ideas, as well as the stocks in the index. Don't forget to follow the index to get early access to videos and be the first to see when I add a stock. If you do sign up for Stock Card, use the promo code BOWTIENATION, all one word and lowercase, for an exclusive discount beyond the free trial. I showed you how the index is set up in our first video. The Bowtie Index is the top 10% of that large cap stock market, the best 1 in 10 stocks among the 500 largest companies based in the United States. I'm excited to get to those stocks I'm buying, so I'm going to link to all the videos in this series in the description below, so check those out for the complete process of how I'm picking these stocks for this index. I'll reveal some of my favorite bank stocks later, but first, one of the best picks and shovels plays in financials with shares of CME Group, ticker CME. The company operates the world's largest derivatives marketplace with futures trading on the Chicago Mercantile Exchange, as well as foreign exchange, fixed income trading, and is the exclusive market for S&P futures contracts. This is a giant part of the market for risk hedging that most investors just never see, but it does facilitate trillions in swaps, options, and futures for every commodity. And I call this that picks and shovels play because the CME Group makes its money facilitating all these transactions on fees paid for each contract traded on its markets. The company is continuously innovating and launching new products to drive revenue, increasing financial products revenue by 35% annualized pace since 2014. Not only is the company growing revenue by more than 10% a year, but it's doing it at an operating margin nearly twice that of its peers, an operating margin of 56%. That's about the highest you'll ever see. The shares trade for just 2.2 times on a price to book value, a 43% discount to the industry average, and well under the 2.6 times average multiple over the last 5 years. Analysts have an average target price of $200 a share here for about 18% upside beyond the 2.3% dividend on the stock. Now, also in that picks and shovels theme is S&P Global, ticker SPGI, the premier data and benchmark provider in finance. S&P combined with HIS Markit last year to merge its data and benchmarking tools with the leader in supply chain intelligence. That was a very smart move, as that bottleneck in supply chains over the last couple of years has put a premium on market intelligence and data. Combined, the new company will get about a third of its revenue from that market intelligence segment and a third from its rating agency on bonds, along with 4 smaller segments. Revenue growth has been a little slower than its peers over the last few years, but I really like what this merger does for the business, and besides that boost to revenue, I think this comes through with stronger profitability as well. Analysts have an average target price of $390 a share, just over 22% upside from here, but this is a long-term hold for great financials exposure. We're just getting started here, but I want to show you exactly what I'm looking at and why it could mean surprise profits for the banks in 2023. Now, I showed you this graph earlier. This shows how much money the 4 major banks took off of their income in 2020 at that height of the pandemic. That is tens of billions of dollars set aside at just 4 banks. And now understand what this is. When banks start getting worried about the economy and that defaults on the loans that they've made could increase, they take money off of their profits and put it into a special what-if account called loan loss provisions. Now this is a cash account set aside just in case the economy really tumbles. But then taking that money off profits makes earnings look surprisingly weak while they're doing it, even though they still have that cash. So what happens there? And this chart is beautiful if you're an investor, but you see here on the left, 2021, when the economy didn't collapse, the banks were able to take those billions of dollars set aside and add it back into profits. It was this surprise profit boom that drove bank stocks up 126% from those pandemic lows. Well, now we see the banks doing the exact same thing. In the third quarter alone, the right side of the chart Just the 5 largest banks set aside more than $4 billion in their loan loss accounts, and that follows another $4 billion in the second quarter. So even if we do get a recession in 2023, I believe we're going to see the banks bring back all this cash back into profits and could see a repeat of that massive post-pandemic return. I want to get back to our list of stocks, but you're going to notice not all of these are bank stocks. I wanted to get more diversified exposure across those financial sector with data services, asset management, and credit. That's going to be important for a longer-term portfolio like this, but I'm really excited for the next couple of years for these stocks. I'm primed to take advantage of all of this is Bank of America, ticker BAC, one of the largest banks with over $2.5 trillion in assets. This is the perfect example for bank stocks this year. BAC reported a 9% drop in its third quarter profit, in line with the other banks, but still beat estimates for 81 cents a share. Now, net interest income, that core income a bank makes on its loans, was up a whopping 24% from last year. So actually a really good quarter, but management moved $378 million to its loan loss reserves. Now, for comparison, in the year-ago quarter, it brought back $1.1 billion from that loan loss account into profit. So the change it reported in profits was 18 cents a share. Without this change, the bank would have reported an 11% gain in earnings. So again, I think the banks are actually doing much better than investors even realize. Bank of America is positioned as the second largest money center bank, next only to JP Morgan for size, and it's a top deposit gatherer, meaning it has all the funding it needs to make those mortgages and other loans for that interest income. It's also got the investment banking and the brokerage through its Merrill Lynch acquisition that gives it that capital markets diversification. It's this kind of competitive scale and scope advantages that you only find with a handful of banks. Of course, as is often the case, that quality comes at a price, and shares here are a little more expensive than the industry average. That price-to-book ratio of 1.2 times is a little higher than the 1.1 times average for the larger banks, but not expensive versus the 1.4 times book it reached last year. Analysts have an average target price of $44 per share for BAC, about 20% upside on top of that 2.4% dividend yield. Goldman Sachs, ticker GS, was one of the few banks to report growing earnings in the third quarter with a 63% increase in profits on 26% revenue growth. Now, where Bank of America has some capital markets exposure but gets most of its revenue as a commercial bank, Goldman is just the opposite. It's arguably the best capital markets bank in the world for investment banking and trading revenues, though it still does make some money on that lending as well. So I like to have a combination of these two banks in a portfolio to give you both types, that commercial banking and capital markets. And while Goldman blew away its earnings, it still got set back on that loan loss provision idea that we're talking about. The bank put away $284 million into that what-if cash account for a total of $4.85 billion. And to show you what kind of an opportunity it is here, that loan loss account had as little as $800 million in it as recently as 2017. That's a difference of more than $4 billion, some of which could be returned to earnings to boost those profits. As for the fundamentals, growth has always been Goldman's strength, posting a 20% annual growth in revenue over the last 3 years. That's almost 10 times the industry average. Goldman Sachs is one of the best-run banks and posts the highest returns on assets and equities among its peers. And where its price-to-book valuation of 1.1 times is higher than the peer group, that's still about as low as I've ever seen it for this stock. Shares of Goldman typically go for at least 1.3 times book value or more. Shares are up 22% since adding it to the index in July, so analysts don't see a lot of short-term upside here, but the stock does pay a 2.8% dividend, and I think we see a big bump when those loan loss provision ideas play out. Two more stocks to highlight, with one of them a top 5 holding in my own portfolio. We spent the last couple of videos outlining the factors that I'm using to pick stocks for the Bowtie Index, the quantitative and qualitative analysis that are going to help the index outperform. I want to get back to our list, so I'm going to link to those videos in the description. Check those out because this is a really unique strategy that you can use to find stocks to buy. BlackRock, ticker BLK, is the largest asset manager in the world with almost $8 trillion in assets under management. In fact, if it were a country, only China and the United States would have a larger economy. BlackRock is the company behind the iShares exchange-traded funds, along with index funds that power its passive investment strategy for retail investors as well as institutionals. It's a very stable source of cash flow to complement the trillions of dollars in credit market and forex asset it manages. Revenue growth is double the industry average over the last 3 years at 15% and has increased to 19% over the last year. Not only is it growing faster, but profitability is 3 times that of its peer average, with an operating margin of 39% over the last year. While growth in China has slowed over the last couple of years, it could become one of BlackRock's core strengths in the years to come. The company was granted permission to be one of the first asset managers to provide mutual fund business in the country, and its biggest competition, Vanguard, largely gave up on the market in 2020. Credit markets and foreign exchange haven't done well this year, so a lot of analysts have pulled back on their targets, which is why we see limited upside here on BlackRock. But the shares pay a 3% yield, and this is going to be a strong one when the next bull market appears. Now here, I know I'm going to hear about it in the comments, but all you out there in the nation know I had to add PayPal Holdings, ticker PYPL, to the index. PayPal is locked into some of the biggest growth trends in financials, including peer-to-peer payments, mobile payments, the blockchain, and digital wallets. Its digital wallet app Venmo has 83 million users and is terrifically under-monetized. Right now, these wallets are only being used for payments, but in the future, this could handle all your financial services, including insurance, banking, loans, and investing. That's going to make PayPal a super app, and revenue could take off. After a 60% drop in the shares this year, I think PayPal is one of the most attractive growth stocks out there on a valuation basis, trading at just 3.3 times sales. That is a 75% discount to the price to sales multiple it traded on in 2020, and sales are growing at double digits a year. PayPal and PayPal-owned Venmo are currently the top two most popular digital wallets, even above Apple Pay and Block's Cash App. The upside here means there is a lot of competition, but PayPal still rules the space and is constantly innovating to bring new services to customers. I think it's only a matter of time before the company really starts monetizing those wallet users to the full extent possible, and that's going to mean a big jump in earnings. Granted, it is a long way back to PayPal's high of $290 a share, but I'm betting it gets there on that wallet idea. In the meantime, analysts have a $115 average price target on the shares for a 48% potential return over the next year. Click on the video to the right for the one energy stock I'm adding to the Bowtie Index, up 350% in the last 2 years, and I like it for even higher. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.